Welcome to the deep dive. Today we're going to be diving into a pretty intense hypothetical scenario. Uh, the MOASS, mother of all short squeezes. Now, given your background in finance, you're already familiar with like the ins and outs of short selling, but we're going to be looking at like the domino effect that MOAS could trigger, how every player in the system would be impacted, and yeah, what could it mean for the global economy, really?
Yeah, it's almost like we're mapping out like a financial earthquake, right? Like we're going to trace these tremors from the epicenter and see how they radiate out to the whole global financial system. So, yeah, lots of moving parts, complex chain reaction.
Lots of moving parts for sure. So let's set the stage here. You've got hedge funds with big short positions on a particular stock, right?
Yeah.
Then something happens, some unexpected news, maybe a surge in retail buying or something that makes the price jump up really fast. What happens next?
That's when the squeeze really starts, right? The price climbs, and all of a sudden the short sellers start to feel the heat. They're facing some pretty serious losses, and then their lenders, usually their prime brokers, they issue margin calls, right? They need more collateral to cover those potential losses.
So it's almost like a game of musical chairs, but the music is speeding up, right? And all these hedge funds are scrambling to meet these margin calls.
Exactly, yeah. And they're forced to liquidate assets, I mean, sometimes even at a loss, just to meet those margin requirements. And the thing is, the more they sell, the more the price drops, which just triggers even more margin calls. It just becomes a vicious cycle.
And this is where that leverage that we talked about earlier really comes into play, right? The more leverage they've got, the more vulnerable these funds are to these really fast price swings.
Absolutely. Leverage it's a double-edged sword. I mean, in a bull market, it can really boost returns. But in a scenario like this, where prices are just, going through the roof, it can absolutely destroy them.
So we've got these hedge funds. They're facing this avalanche of margin calls, right? They're desperately trying to sell off assets just to stay afloat. But what happens if they can't meet these demands?
Well, that's when the real trouble starts. If they can't meet those margin calls, they could default. And those defaults, they're going to hit their prime brokers, the institutions that are providing them with the leverage and the services.
So now the pain is starting to spread outwards. So now the prime brokers, they're facing these big losses from the hedge fund defaults. What kind of impact does that have on them?
Well, I mean, it really depends on the size and the stability of the prime broker, right? But even the biggest institutions, they could be hit pretty hard. They might have to just absorb those losses themselves, which, would weaken their capital reserves. And in a really bad scenario, it could even lead to the failure of a prime broker.
And that would send shockwaves through the whole system, wouldn't it?
Oh, absolutely. Prime brokers, they're interconnected with all these other financial institutions. Banks, clearinghouses, even central banks, right? A failure at this level would have, I mean, it would be like a domino effect, triggering a whole cascade of losses and potentially a systemic crisis.
Okay, so let's talk about those dominoes. Who gets hit next?
Well, remember those brokers that extended margin loans or facilitated short selling for their clients, including retail investors? They're next in line.
So it's not just the big institutions that are feeling the heat. Retail brokers are in the mix too.
Oh, yeah, definitely. As their clients, especially those that are, heavily leveraged on the short side, if they start defaulting on their obligations, the brokers, they face a liquidity crunch. They have to cover those losses. And if they can't, their own solvency is at risk.
It sounds like a financial contagion, spreading from the hedge funds to the prime brokers to retail brokers. And it's all because of this initial short squeeze on just one stock.
Yeah.
It's pretty wild how quickly it can escalate.
Yeah, and we're not even done yet. We got to talk about the market makers, the ones that are responsible for providing liquidity and making sure that trading in the market goes smoothly. They're also caught in the crosshairs.
Right, the firms like Citadel Securities, Virtue Financial, all those names we hear about. What happens to them in this scenario?
They're facing a unique challenge, right? As
Okay.
the volatility explodes, the prices surge, they've got to provide liquidity on both sides of the trade. But with a MOS, I mean, the buy-side pressure is just overwhelming. It could force them to take on massive short positions just to meet their market-making obligations.
They're basically trying to hold back this tidal wave, risking their own capital in the process.
Exactly, yeah. And their typical payment for order flow revenue, I mean, it wouldn't even come close to offsetting the potential losses. They could be looking at a really serious liquidity crisis or even insolvency.
So far we've got hedge funds imploding, prime brokers on shaky ground, retail brokers scrambling, and market makers about to collapse. Sounds like the whole market's teetering on the edge of chaos.
And that chaos, it wouldn't just be limited to the financial markets. The real economy would feel the tremors too.
Let's get into that. How would AMOS impact, businesses and individuals outside of Wall Street?
Well, first of all, think about the banking sector. Banks, they're heavily exposed to the financial markets, both directly and indirectly. They lend to financial institutions, they hold assets that are tied to the market, and they depend on a functioning financial system to carry out their day-to-day operations.
So as these financial institutions start to fail, the banks would start feeling the pain as well. It could trigger a credit crunch, right?
Yeah.
Making it harder for businesses and people to get loans.
Exactly. And a credit crunch, I mean, that could quickly snowball into a recession. All of a sudden, businesses can't get the funding they need, consumers are cutting back on spending, and the whole economy comes to a grinding halt.
And we can't forget about the payment system, right? If the financial system breaks down, it could disrupt, people's ability to make payments and settle transactions. That would have a devastating effect on everyday life.
Oh, for sure. Imagine, not being able to use your credit card. Businesses can't pay their employees. Global trade just grinds to a halt because the payment systems are frozen. I mean, it would be chaos.
So we're potentially talking about a scenario that could cripple the global economy. And it all stems from this short squeeze on one stock. It's pretty hard to even grasp how big the fallout could be.
Yeah, it's a sobering thought. And we haven't even touched on how regulators might respond or what the long-term consequences could be.
Yeah, we'll definitely dive into those in the next part. But for now, I think we've got a pretty clear picture of how a MLS scenario could unfold. Step by step, from the initial short squeeze to this potential for global economic chaos.
Yeah, it's a complex web of interconnections. Every player in the system, I mean, they're all vulnerable to these shock waves. I think understanding these connections, it's really important, even if a MO is, still a hypothetical scenario. It really helps us understand how fragile the system really is and how crucial it is to manage risk effectively.
Well said. We'll be right back.
Okay, so we've seen how MOASS, how far the fallout could reach, right? Affecting everything from hedge funds to the global payment system. So let's talk about how regulators might respond to a crisis like this.
It's almost like we're talking about a financial wildfire, right? What tools do regulators actually have to contain a blaze like this?
Well, I mean, I think the first line of defense would probably be circuit breakers, those automatic trading halts that are designed to kind of prevent panic selling and give the market a chance to catch its breath. I mean, we've seen them in action before during those times of really extreme volatility.
Right. Like during the flash crash back in 2010 or the market turmoil during COVID. But wouldn't halting trading in the middle of a MOASS with a stock potentially, skyrocketing, wouldn't that actually help the short sellers who are being squeezed?
Yeah, it's a valid point. I mean, some people would definitely argue that halting trading would just be artificially propping up these failing institutions and that it kind of goes against the whole idea of a free market. But, regulators, they're often stuck between a rock and a hard place, right? They have to choose between letting the market just run its course, which could make the crisis worse, or stepping in to prevent a complete meltdown.
So it really becomes a question of priorities, right? Is the goal to protect individual investors, even the ones that maybe took on too much risk? Or is it about safeguarding the stability of the entire financial system?
Exactly. And in a MOS situation where the ripple effects could be so huge and so unpredictable, I think regulators would probably focus on systemic stability over, the fate of individual players.
It's a tough call for sure.
Yeah.
Are there any other tools that regulators could use to kind of regain control of the situation?
Well, they could try a short selling ban. Now, this wouldn't do anything to address the underlying price surge, but it could prevent more fuel from being added to the fire. I mean, we've seen this tactic used before, most notably during the 2008 financial crisis.
Right. The SEC, they put a temporary ban on short selling certain financial stocks. But wouldn't a ban like that be, I don't know, pretty controversial, especially in the context of a MOAS? A lot of people see short selling as a legitimate investment strategy.
Oh, absolutely. A short selling ban, some people would definitely see it as market manipulation, and it could potentially undermine confidence in the fairness and integrity of the whole system. But if they were faced with a potential systemic crisis, regulators might feel like they have to use every tool they have to try and restore order.
Yeah, it sounds like a real dilemma, limiting the market's freedom to try and protect its overall stability. But let's say those measures aren't enough. What happens if the situation just keeps spiraling out of control?
Well, then we might see the Federal Reserve stepping in with those emergency liquidity injections, basically acting as the lender of last resort to try and prevent a total collapse of the financial system.
So we're talking about potentially trillions of dollars being pumped into the system to prop up these failing institutions. It sounds a lot like the bailouts we saw back in 2008. Wouldn't that raise concerns about moral hazard?
Yeah, that's a valid concern. I mean, critics would definitely argue that interventions like that just create this safety net for reckless behavior and that it would encourage, even more excessive risk-taking in the future.
So it's like this balancing act. On the one hand, you've got this immediate need to stabilize the system and prevent this widespread economic damage. But on the other hand, you have this long-term risk of encouraging irresponsible behavior and kind of undermining market discipline.
Yeah, exactly. It's a tough spot for regulators. They're always navigating these complex trade-offs. There aren't any easy answers, especially in a situation like a MOS where everything's moving so fast and the stakes are so high.
It seems like there's a lot of potential for unintended consequences with these types of interventions. How might the market react to such drastic measures?
Well, even if those interventions do manage to stabilize the market in the short term, there would probably be some pretty long-lasting effects on market sentiment and investor behavior. Remember those online discussions we mentioned? There's this growing distrust of those traditional financial institutions. This belief that the system is rigged against individual investors. And an MOS, even if it's contained, I mean, it would just add fuel to that fire.
So we could see a loss of trust in the market, right, leading to people being more risk averse and maybe a flight to safety.
Yeah, it's definitely possible. Investors, they might pull out of equities and look for, safer havens in less volatile assets like bonds or even gold. And that could have a real dampening effect on investment and economic growth.
And wouldn't a MOS also lead to more calls for increased regulation?
Oh, for sure. There would be a ton of pressure to reform the system to make sure that something like that never happens again. And we could see stricter rules on short selling, tougher capital requirements for hedge funds and brokers, even a complete overhaul of the whole market making system.
So the regulatory landscape could change in some pretty big ways. It could reshape the entire financial industry.
Hmm.
But what about the impact on technology and innovation? Could
Mm.
could a MOS actually speed up the adoption of new technologies?
That's an interesting thought. Crises, I mean, they often act as this catalyst for change, right? The financial system, especially its technological infrastructure, I mean, it would be under a ton of strain during a morass. And that could expose weaknesses and inefficiencies and lead to a push for more robust and resilient technologies.
So we might see more investment in areas like blockchain, decentralized finance, and other technologies that offer increased transparency and security and efficiency.
Yeah, it's definitely possible. The current system, even with all its safeguards, it still relies on these centralized institutions and intermediaries. And MOS, I mean, it could really highlight the limitations of this model and drive innovation in areas that are trying to decentralize and democratize finance.
So this hypothetical MOS, it's not just about potential financial chaos. It also presents this potential opportunity for innovation and maybe even a reimagining of the whole financial system as we know it.
Exactly. Every crisis has dangers and opportunities, right? And I mean, yeah, it would definitely be disruptive, but it could also lead to a stronger, more transparent and fairer financial system in the end.
It's fascinating how this hypothetical scenario touches on so many different parts of our financial system and even our society as a whole. But what does it all mean for individual investors? How should they be thinking about this information and preparing for the potential fallout?
That's a really important question and one that we'll dive into in the final part of our deep dive.
Okay, so we've talked about how a MOASS could work and the domino effect it could have on the financial system from hedge funds to prime brokers, market makers, and even the global economy. And then we got into the potential responses from regulators, like trading halts, short selling bans, and those massive liquidity injections. But let's shift gears a little bit. What does all this mean for individual investors, like you?
Yeah, for sure. I think navigating a world where even if it's just hypothetical, is a real possibility, means we need to rethink those traditional investment strategies and how we approach risk management.
Okay, so let's get practical here. We've laid out this pretty vivid, maybe even a little unsettling picture of this MOASS scenario, right? But what should individual investors do, especially those who really understand the financial markets? What are the big takeaways here?
Well, the first thing is you got to stress test your portfolio. I mean, diversification across different asset classes and sectors, it's still super important, but it might not be enough in an extreme scenario like a MOS. You got to think about, what if the market crashes and everything's correlated, Those traditional safe havens, they might not offer the protection they usually do.
So it's not just about diversifying across different types of assets. It's also about understanding how those assets will behave when things get really crazy in the market, right? Are there any specific strategies or tools that investors can use to really assess these correlations and get ready for the unexpected?
Yeah, absolutely. Scenario analysis and stress testing, those are essential. Look back at historical market crashes, even the ones that seem totally unrelated to what's happening now. See how different asset classes performed during those times, and then think about how your portfolio would hold up under similar conditions.
So it's about going beyond those standard assumptions that portfolio models use and really digging into the potential for these black swan events, like MOS. What else should investors be thinking about here?
Another big takeaway is the need to really think critically about leverage, both for yourself and for the system as a whole. We've talked about how too much leverage can magnify losses and make things unstable. So as an individual investor, be careful about how much leverage you're using, especially when the markets are volatile. Understand the risks of margin trading and the possibility of forced liquidations.
Yeah, it's a good point. Leverage it's a powerful tool, but it can amplify both your gains and your losses.
Yeah.
It really requires you to be careful and to really understand the risks. Any other practical tips for investors who are trying to navigate this crazy landscape?
Yeah, focus on financial literacy, not just for yourself, but for everyone around you. Encourage people to make informed decisions and to be responsible with their investments. I mean, a MOS scenario, even if it never actually happens, it reminds us that the financial system is all interconnected and we all have a responsibility to keep things stable.
So it's not just about protecting your own money. It's about creating a culture of financial awareness, right? And building a financial system that's more resilient and fair. Any last thoughts for our listeners as they think about all this and their own investment strategies?
Yeah, I mean, stay informed, stay engaged, and never stop learning, right? The financial world is always changing. New technologies are coming out, regulations are changing, and the market dynamics are constantly shifting. MOA is just one hypothetical scenario, but it really highlights how important it is to adapt, to evolve, and to always question your assumptions.
Really great advice. And with that, we've reached the end of our deep dive into the potential implications of MOAs. We've looked at how it could happen, the domino effect, the responses from regulators, and even the potential for innovation that could come out of it. Hopefully this deep dive has given you some valuable insights and maybe even inspired you to rethink your approach to the financial world and all its complexities.
I think as financial professionals, we have a responsibility to really think through these scenarios, no matter how unlikely they might seem. By understanding the potential risks and opportunities, we can make better decisions. We can help create a more resilient system, and ultimately we can face the future of finance with more confidence.
Well said. That's all the time we have for today's deep dive. But keep those conversations going, do your own research, and keep thinking critically. Stay curious, stay informed, and as always, happy investing.